Guys, the inflation report that we got this morning from the Department of Labor confirms that the Fed will cut rates soon at their next meeting in a couple of weeks. The U.S. has pretty much turned the corner on inflation, right? This morning, we got the CPI numbers in for headline inflation, and we also got the core CPI numbers in. The core CPI, just as a reminder, the core CPI leaves out food and energy because it says food and energy is too volatile. And food and energy are sort of tied together, right? And they sort of have large swings up and down. Now, keep in mind, guys, we're not out in the fields picking greens and beans. So it takes energy to make and produce and manufacture and ship or package and ship our food. So food and energy are sort of lumped together and left out of the core CPI numbers, but are included in the regular CPI numbers, right? And the core CPI numbers is what the Fed looks at to make its decision on whether or not to raise interest rates, lower interest rates, or keep them the same. The Fed wants the core CPI numbers to be down to around 2%. So here's today's data at a glance. Let's take a look at what happened. So guys, this is a quick chart of the annual inflation rate since 2019. But today, CPI inflation year over year saw a 2.9% increase versus a 3% expected increase. So CPI year over year headline inflation is only at 2.9%. 2 summers ago, guys, if you can remember, the year over year CPI inflation was at 9.1%. So it's gone down quite a bit, all the way down to 2.9%. CPI inflation for month over month saw a 0.2% increase, matching expectations. Now, the core CPI inflation year over year is at 3.2%, which matched the expectations. And the core CPI inflation month over month increased by 0.2%, which also matched expectations. As you can see on this chart, this was the peak of the CPI headline inflation back in the summer of 2022 when it reached a whopping over 9%, right? But since then, as you can see, it's gone down quite a bit, guys, and it's kind of remained fairly steady, but continues to creep down slowly all the way up until today's readings. Now, again, our inflation is pretty much in line with expectations in the month of July, right? And as you can see on this chart, this is what the Federal Reserve has done with interest rates over the last 20 years or so, right? Right here is where we are right now, guys. Interest rates, the Fed funds rate has remained the same between 5.25% and 5.5% for the last 12 or 13 months or so. About a year, they have not touched the interest rates. However, this latest data sort of opens the door wide open for the Fed at their next meeting to come in and start cutting these interest rates as we get closer and closer to the Fed's targeted 2% inflation rate. Large banks, Goldman Sachs, JP Morgan, they've already raised their projections for a potential U.S. recession, as we see, and we'll get the reports coming in soon about the GDP and how we're actually growing. GDP has been down so far this year as compared to last year. Not to mention delinquency rates. Delinquency rates pretty much reflect the likelihood of a person missing a minimal payment on their outstanding debt, whatever that debt could be, credit cards, automobile loans, etc. So delinquency rates are up. More Americans are skipping their debt payments than ever before, skipping out on the auto loan payments, skipping out on the credit card payments, right? In fact, delinquency rates are at its highest peak since the pandemic started, right? Not to mention, as I said earlier, GDP is slowing. Inflation at this point, though, at the rate we're at with inflation right now, our inflation is really at the lowest level it's been in about 3 years, since 2021. So again, inflation rates are inching closer and closer to that 2% rate that the Fed wants to see, right? This data that we got today is pretty important because it guarantees that the Fed is going to start cutting these rates. Now, the thing you got to think about, guys, is the fact that we've had 2 years of higher than normal interest rates, right? 2 years of it. How has that affected consumers? That's a really serious question, especially for people out here who have low to moderate incomes, right? And maybe have small or medium-sized businesses, right? Even large businesses, but small to medium-sized businesses. How have they been affected by not being able to borrow money cheaper, right? Which of course affects the labor market, which we've seen going up and up and up. Speaking of the labor market, we got to mention this. Cisco layoffs announced today. ExxonMobil layoffs announced today. Farmers Insurance layoffs announced. Intel just laid off about 15,000 employees. That announcement came a while back, and there's more to come, right? Wells Fargo layoffs. And I just read about Paramount Global. They own CBS and MTV and Comedy Central. They're laying off 15% of their workforce. That story came out just yesterday. So be prepared for more and more layoffs, and be prepared to see the unemployment rate go up from the 4.3% reading that we recently had, right? So you see the labor market is cooling. Unemployment is going to go up. And as unemployment goes up, yeah, the Fed is going to make money cheaper to borrow. But if less people are working and able to afford it, and of course, when unemployment goes up, you have sort of consumer sentiment kind of go down, right? Everybody gets a little nervous, even though money is cheaper to borrow. So it's this balancing act that the Fed is having to do in terms of rates. Now, this is all the information that we've been given. Now, we know these numbers, and anytime you work with numbers and work around numbers, you know that numbers can be sort of changed, right? Numbers can be sort of manipulated and so forth. The numbers that we're given is what we have to go off of, right? But again, the labor market is cooling. Delinquencies are going way up, right? And so the Fed is definitely going to make this rate cut, right? The Fed always talks about their dual mandate, right? They talk about maximum employment and price stability. Well, as inflation has come down as you see the numbers we got today, price stability is happening, but the employment is about to take a hit. And that's what has folks worried about. And you should be worried about it, because lots of companies are doing layoffs, guys. If that's you, or you heard of some companies doing layoffs, let me know in the comment section below if you've heard of layoffs, or you know some people that have been laid off, or if that's been you recently. Now, if the August numbers come in for jobs, right, as it did last month, and we see this unemployment tick up from 4.3% to 4.4 or 4.5%, the markets are going to probably demand or want to see the Fed cut rates again in its next couple of meetings that we see coming up at the end of the year. But the question is, when the Fed does cut rates coming up here shortly in a few weeks, are they going to cut it by 25 basis points or 50 basis points, a quarter of a percentage or a half a percentage, right? In my opinion, I think we're going to see a full 50 basis point cut and make money cheaper to borrow, to sort of stimulate the borrowing of money to fight off any type of recession, right? Any type of down public sentiment or down consumer sentiment regarding unemployment ticking up. Now, you don't have to feel obligated to keep this machine running, right? You can sort of cut the cord, cut the strings. When rates get cut, stick to your plans, whatever your plans have been, in terms of whether it's investing, dollar cost averaging, in terms of if it's been, hey, I want to pay off this house, or I want to pay down on some debt, or I want to get rid of all of my debt, right? Whatever your plan has been, your strategy, you don't have to waver because the Fed has told you that rate cuts are coming, right? You don't have to sit on the edge of your seat and say, oh my gosh, rate cuts are coming. Rate cuts are coming. I want to go borrow some money. Now, if you have a small business and you need to buy a piece of equipment and you need to get a loan, totally understandable. If you have to move and go out and buy a piece of property, I totally get it. But you don't have to be consumer minded, whereas every time the Fed cuts rate, now you go borrow money to go buy a car. You go borrow more money on your credit card. You don't have to do that, right? Doesn't mean you have to take the bait. So I just want to give you guys this quick rundown of what happened today, because I thought it was important to share with you guys regarding the fact that, hey, CPI numbers and core numbers have come in great. Inflation report confirms that it's going down, and that means that the Fed is going to cut rates. The corner has been turned in terms of inflation based on what they've shared with us in terms of the numbers. Okay. So, hey, I hope you got something of value. Drop me a comment and let me know what you think, guys. And as always, the best person who's going to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.